The global financial landscape in late 2025 presented a curious enigma, a stark divergence that defied conventional wisdom, as major equity markets across the United States surged by as much as 50%, and other developed nations witnessed even steeper gains nearing 70%. A different story unfolded in the realm of digital assets. Bitcoin, often hailed as the new digital gold and a hedge against uncertainty, found itself lagging, actually losing value year over year. This dramatic underperformance left many investors grappling with a profound sense of relative deprivation. While gold itself climbed by over 50%, questions lingered about Bitcoin's true role and its often counterintuitive dance with traditional safe haven assets. The prevailing narrative suggests that as gold prices rise, Bitcoin, as its digital counterpart, should follow suit. Yet a closer examination of market cycles since 2016 reveals a fascinating, almost paradoxical trend. Time and again, Bitcoin's most significant rallies have not occurred in lockstep with gold's ascent. Instead, they frequently ignite precisely when the precious metal, after a period of robust gains, begins to consolidate or even recede. This curious inversion hints at a deeper underlying dynamic, a subtle redistribution of capital between what investors perceive as old and new stores of value. Take the events of late last year as a prime example. When a major derivatives exchange, the CME, twice raised margin requirements on precious metals futures, it triggered a swift correction in prices, with silver alone dropping 10% in a short span. But in a striking parallel, this very moment marked a decisive turning point for Bitcoin. As funds flowed out of a suddenly more expensive and volatile metals market, a significant portion found a new home in the leading cryptocurrency, initiating a strong rebound. This wasn't merely a coincidence. It was a visible manifestation of capital shifting across the global asset spectrum, seeking new opportunities in the wake of regulatory and market forces. Beyond these immediate triggers, a larger, more intricate web of influences shapes the destiny of digital assets. The political machinations within global economic powerhouses, particularly the United States, play an unexpectedly potent role. Consider the period immediately following the 2024 US presidential election. Hopes for a digital asset first policy, publicly championed by the incoming administration, fueled an astonishing surge in Bitcoin, driving its value up by over 40% in a mere month. Yet, as the focus of the administration swiftly shifted towards nurturing the burgeoning artificial intelligence sector, vast sums of capital began to migrate, inflating valuations in AI-related stocks and their underlying infrastructure like semiconductors. Bitcoin, once at the forefront, suddenly found itself marginalized, relegated to a secondary priority in the grand economic strategy. This interplay of global macroeconomics, political agendas, and shifting technological narratives creates a volatile, unpredictable environment for digital assets. The recent history of Bitcoin is not just a tale of speculative booms and busts, but a complex narrative woven into the fabric of international finance and geopolitics. To truly understand where the digital economy is headed in 2026, we must look beyond the surface price movements and delve into these powerful, often hidden, forces that govern the flow of global capital. The unseen hand of global monetary policy, particularly the nuanced pronouncements and actions of the United States Federal Reserve, acts as an inescapable gravitational force on this flow. Even as digital assets claim to offer an escape from centralized control, the fundamental cost of capital, dictated by interest rate decisions in Washington, profoundly influences global risk appetite. When the Fed embarks on a tightening cycle, elevating borrowing costs, the allure of less volatile, interest-bearing assets within traditional financial markets intensifies. This draws capital away from speculative ventures, including the often unpredictable world of cryptocurrencies, as investors recalibrate their risk-reward calculations. The mere whisper of a hawkish stance from the Federal Open Market Committee can send ripples across equity markets, bond yields, and inevitably, the digital asset landscape. It's a silent yet seismic shift in the economic environment, where the promise of future gains in a volatile asset must outcompete the guaranteed yield of a safer traditional investment. Compounding this effect is the divergence in monetary strategies across the globe. While the US might be in a phase of quantitative tightening, seeking to drain excess liquidity from the system, other major economies, perhaps struggling with slower growth or different inflationary pressures, might maintain more accommodative stances. This creates a complex tapestry of global interest rate differentials. Savvy institutional capital, always seeking the optimal balance of risk and return, will strategically migrate across borders, chasing higher yields in specific government bonds or favoring equity markets in regions where central banks are still injecting stimulus. Digital assets in this intricate dance often become a secondary consideration, either benefiting from a surge in overall liquidity or suffering from its contraction, depending on which global narrative holds sway. This nuanced ebb and flow of trillions across the international financial system forms an almost invisible current, steering the trajectory of every asset class, including those born outside traditional structures. Beyond these powerful central bank machinations, a constant, often paralyzing shadow is cast by the global regulatory environment. Unlike established asset classes, digital assets exist within a fragmented, inconsistent, and often hostile legal framework. One nation might embrace innovation with clear guidelines, while its neighbor might impose outright bans or enforce opaque, ever-shifting rules. This regulatory patchwork is not merely an inconvenience. It represents a significant barrier to the true unlocking of institutional capital. Major financial players overseeing vast sums and answerable to stringent compliance mandates simply cannot engage fully when the rules of engagement are unclear, when legal definitions vary wildly, or when the specter of retrospective legislation looms. The cost of navigating this labyrinth, coupled with the inherent reputational risks, often outweighs the perceived benefits, thus keeping a substantial portion of global capital on the sidelines, observing rather than participating. This cautious stance from the traditional financial guard creates a unique tension. On one hand, there's a clear desire to harness the efficiency and innovation promised by blockchain technology. On the other, the profound uncertainty surrounding how governments and regulators will ultimately classify, tax, and police these digital instruments acts as an anchor. The ongoing, often acrimonious, debates within legislative bodies and regulatory agencies around the world about what constitutes a security, a commodity, or simply a currency for digital assets are not academic exercises. They are pivotal discussions that directly influence billions of dollars in potential investment, shaping the very infrastructure and future viability of the digital economy. The absence of a unified, internationally coordinated approach to digital asset regulation is, in itself, a powerful, albeit negative force governing capital flow, restricting its reach and stifling its potential. One such powerful, yet often underestimated force is the relentless gravitational pull exerted by the world's most influential central banks. Throughout late 2025, the United States Federal Reserve maintained its cautious posture, holding benchmark interest rates at levels that continued to make traditional, regulated financial instruments exceptionally appealing. This created a profound dilemma for investors. Why venture into the less predictable, more volatile terrain of digital assets when a secure, government-backed bond offered a tangible, risk-adjusted return that, even if modest, was guaranteed? This subtle yet persistent pressure from high interest rates acted as an invisible tether, restraining the broader surge of capital into nascent markets and keeping liquidity firmly anchored within established financial harbors. The narrative of digital gold began to unravel under this sustained monetary pressure, not because its fundamental promise diminished, but because the immediate economic calculus shifted dramatically. With the cost of capital remaining elevated, the speculative appetite for assets lacking clear regulatory pathways or consistent institutional on-ramps naturally waned. This wasn't a sudden rejection. It was a slow, deliberate reevaluation by sophisticated capital. Moreover, the shifting priorities within political power centers, particularly the rapid pivot away from an anticipated digital asset-first agenda, exacerbated this effect. When political will and regulatory momentum falter, the path for institutional capital, which thrives on certainty and established rules, becomes fraught with unacceptable levels of risk. The absence of a clear, comprehensive regulatory framework, particularly within the United States, functioned as a formidable barrier. Major investment funds, pension schemes, and corporate treasuries, managing trillions of dollars, operate under strict fiduciary duties and compliance mandates. They require explicit legal guidance on asset classification, robust custodial solutions, and predictable tax treatments. Without this bedrock of regulatory clarity, the vast reservoirs of institutional capital, which could have provided the much-needed ballast for the digital asset market, remained largely inaccessible. This left the sector vulnerable, primarily driven by retail sentiment and short-term speculative movements, perpetuating the very volatility that deterred larger, more conservative investors. The complex interplay of sustained high interest rates, wavering political support, and persistent regulatory uncertainty conspired to create a challenging environment, transforming what many hoped would be an exponential growth trajectory into a period of frustrating consolidation and relative underperformance. It revealed that even the most innovative technologies cannot escape the fundamental economic principles that govern the allocation of global capital. One such force, often underestimated in its far-reaching implications, is the nuanced dance of global liquidity. As central banks globally navigated the tightrope between inflation control and economic growth throughout 2025, the withdrawal of pandemic-era stimulus continued to drain excess capital from the system. This quantitative tightening, though often discussed in terms of bond markets and interest rates, had a profound, often indirect, effect on speculative assets. With less cheap money sloshing around, investors became more discerning, prioritizing immediate returns and clear regulatory frameworks. Bitcoin, despite its long-term promise, found itself in a competitive environment where capital was no longer freely chasing every promising narrative. Simultaneously, the global regulatory tapestry for digital assets remained a patchwork, riddled with inconsistencies that either stifled innovation or created pockets of intense speculation. While some nations moved towards comprehensive frameworks, offering clarity and attracting institutional players, others remained hesitant, fostering an environment of uncertainty that deterred large-scale capital deployment. Major financial institutions, with trillions under management, continued their cautious exploration, often preferring the regulated pathways of exchange-traded funds and derivatives rather than direct spot market exposure. This preference illuminated a fundamental tension: the innovative spirit of decentralized finance clashing with the traditional finance world's imperative for oversight and compliance. This cautious approach meant that when the political winds shifted, funneling resources and attention towards the AI sector, the inertia of traditional finance found an easier, more regulated path to follow. Investing in NVIDIA or established semiconductor giants required far less regulatory gymnastics than navigating the often opaque world of cryptocurrencies. Thus, Bitcoin's struggle was not merely a matter of fading interest, but a symptom of a larger systemic recalibration, where the global financial architecture was actively seeking clarity and efficiency in its capital allocation, often at the expense of frontier markets lacking uniform rules. The market was actively prioritizing perceived certainty and established regulatory channels over the promise of disruption. The year 2025 drew to a close, not with a bang, but with a quiet, almost imperceptible realignment of global financial priorities. The grand experiment of decentralized finance, once hailed as the inevitable successor to traditional banking, found itself in a moment of profound introspection. The narrative, so compelling just a few years prior, had encountered the unyielding force of an increasingly sophisticated, yet inherently cautious, global capital market. What we witnessed was not a failure of the underlying technology, nor a complete rejection of Bitcoin's revolutionary ethos. Instead, it was a stark demonstration of how deeply human psychology, political will, and the siren song of immediate, tangible progress influenced the flow of trillions. The dream of a borderless, permissionless financial future had collided with the very real, often bureaucratic, boundaries of sovereign states and established institutions. The market, in its relentless pursuit of efficiency and certainty, had made its choice, and that choice, for the time being, gravitated towards the more familiar, more regulated, and seemingly more immediate promise of artificial intelligence. The capital, once overflowing and indiscriminate, seeking any nascent opportunity in the digital Wild West, had become a swift, directed current. It flowed not into the unpredictable depths of crypto lending protocols or the volatile peaks of meme coins, but into the well-charted rivers of AI research, semiconductor manufacturing, and data infrastructure. Companies like NVIDIA, once merely chip makers, transformed into the very architects of this new digital age, their market caps swelling to unprecedented heights, fueled by the conviction that their innovations offered a clearer path to measurable returns and societal impact. This was the resolution of the immediate conflict, a reprioritization, a re-evaluation of where the true engines of growth were perceived to lie. The echoes of this shift will resonate through history. It taught us, yet again, that innovation alone is not enough. It must be cradled within a framework of trust, understanding, and predictable governance if it is to truly capture the vast reservoirs of institutional wealth. Bitcoin's journey, and indeed the broader cryptocurrency movement, became a powerful, living laboratory, exposing the profound chasm that exists between visionary technological potential and the practical, often messy, realities of integration into a global economy built on centuries of established order. The lingering question, then, is not whether Bitcoin or decentralization will ultimately triumph, but how they will adapt. Will the pioneers of Web3 find common ground with the regulators, forging new hybrid models that blend the best of both worlds? Or will they forever remain on the fringes, a powerful, albeit niche, alternative to the mainstream? The dust had settled on one battleground, revealing a new landscape defined by the tangible and the regulated. The speculative fervor, the breathless anticipation of a world overturned, had given way to the methodical, strategic deployment of capital into technologies that offered clearer roadmaps and fewer regulatory hurdles. The story of Bitcoin's struggle in 2025 is a chapter not of failure, but of evolution. It underscores the enduring truth that even the most disruptive innovations must, at some point, confront the gravitational pull of established power structures and the human craving for order. The world, having caught its breath after the whirlwind of digital disruption, turned its gaze to the next horizon, a horizon shimmering with the promise of artificial intelligence, a promise that, for now, offered a more direct and less contentious path to the future. And as the global financial gears continued to turn, Bitcoin remained, not forgotten, but redefined. A testament to an audacious dream, now navigating a reality far more complex than its early architects could ever have imagined.